The Reserve Bank has continued to raise the official cash rate, but questions have been asked about whether the 3% OCR is strong enough to take the wind out of inflation sails. To discuss in more detail, we're joined by the Reserve Bank's Chief Economist, Paul Conway. Thanks for joining us, Paul. I'm just wondering, are you confident of the hikes you've done to date?
We're not finished. So our projection for the OCR has got it getting up to around 4%, a little bit above 4% by the end of this year, early next year. So, I think we're on track to get inflation back in the box. Yes, absolutely. But we've got a ways to go in terms of, a few more rate hikes, which I should say have been more or less priced in by markets. So yeah.
Yeah, and your statement that you released last week, all your forecast tracks were beefed up essentially to take into account an OCR 4.1%?
There was, essentially the economy has unfolded broadly as we anticipated in the May monetary policy statement. So to some extent, we were sort of just rolling it over a quarter. There were some differences here and there, but in terms of the rate track, at least, it was broadly consistent with what we had there in May. I think the difference was that we have, we want to get the job done. So we, perhaps brought forward some rate hikes a little bit, sort of in the idea that we will get interest rates in this economy comfortably above neutral so that we can slow down demand in the economy, which is exactly what we need to bring inflation down. And we wanted to get that done sooner rather than later. And if we can get the OCR up around that 4% mark by the end of the year, then next year will be about the Reserve Bank doing what central banks love to do, which is to watch, worry and wait and sort of see the effects of the rate hikes on the economy.
Still going to be a long time, though, before inflation gets back down, even touches the target band.
We've got inflation hitting 3% towards the end of, mid-2024. We're on track to deliver low inflation. It's not going to happen overnight, but it's, we're definitely heading in that direction. We're pretty confident that the 7.3% inflation rate that we saw in the June quarter was the peak, that it's going to be lower in the September quarter, and then significantly lower next year, and then back into the band the year after that. I should say, Jonathan, we're required to not cause unnecessary instability in the economy through our policy action. So it's not all just about getting inflation back into that target band as quickly as possible. There are other sort of objectives that we need to weigh up and take into mind when we're making our OCR decisions.
It seems like no one can foreshadow or predict what inflation's going to do, though. Last week, the UK, Europe went into 10%.
Look, it's been a tricky time for economic forecasting. Absolutely. I think even at the best of times is a tricky time for economic forecasting. And now is not the best of times with lots of volatility in the global economy and New Zealand, of course. I should say our monetary policy statement, it's our best foot forward at a particular point in time. All economic projections have huge error bands, margins of uncertainty around them, but this is very much how we see the economy unfolding as of August 2022. And I should say, since I've been at the bank, which is coming up to 4 months now, the New Zealand economy has been unfolding as we expected. Of course, past performance is no indication of future performance, and we may well be surprised going forward, in which case we will alter our projected OCR track accordingly.
So that is projected to show a slowing New Zealand economy, but you're not forecasting a recession?
I don't think so. To be honest, I'm not too hung up on the will it be a recession, won't it be a recession. I think next year we've got consumption growth very low. I think we've even got falling consumption on a per capita basis. So, I think the economy, we've got some work to do. We've got a slowdown coming up, and that's what we need to do to sort of invest in a low inflationary future. Whether or not GDP growth sort of dips into 2 quarters of negative growth, which is the technical definition of a recession. I mean, the difference between that, if they're just small negative numbers or zero, is I don't see a recession as being a kind of binary thing. You're either in one and it's terrible, and you're not and it's great. There's shades of grey in between those two outcomes, and we're sort of traversing that line currently and over the next year or two.
Do you think the hikes in the official cash rate have had the desired effect of tackling inflation so far?
I think that aggregate demand and spending in our economy is still a little bit too hot. I think it's beyond the supply capability of the New Zealand economy. But one thing that we're starting to see the effects of a higher OCR around the place. So absolutely, monetary policy works. It is working, I guess, most obviously in the housing market. Recent falls in house prices, higher interest rates have no doubt got something to do with that. There's also some areas of spending where we're starting to just see a softening. I think things like buy now, pay later have seen significant declines over the last few months. But, overall, in aggregate, spending is still very much hanging in there, but we are starting to see signs at the margin of monetary policy, working. And not least of all, I should say, inflation expectations have declined a bit as well between the August and the May monetary policy statement, which is another sign that monetary policy is having the desired effects, or starting to at least.
Okay, but in the meantime, though, you're going to be keeping up your hawkish rhetoric?
Well, I don't really consider myself or the Monetary Policy Committee to be a hawk or a dove. We just sort of deliver the interest rate path that we see as being required at the time. I do think that at some point in the future, we will get to the point of saying, okay, we need to see the impacts of the changes in the cash rate that have been put in place already, but I don't think we're there yet. I think we're not far away. That could be the end of this year, sort of thing, barring any surprises between now and then.
I want to also just talk about the monetary policy review, where you're assessing the decisions made over the past 5 years. What are the actual benefits of that, given it's all retrospective? The decisions have already been made.
Yeah. Well, first of all, we're required by legislation to review monetary policy in 5 yearly chunks. This is under the new Act. So it's the first review that we've done. And I think your point, you sort of have to judge the decisions made by the Monetary Policy Committee on the basis of the data or the economy that they had in front of them at the time. But then I think there are lessons for a central bank, for us, Te Pūtea Mātua, the Reserve Bank, looking back over that 5-year period and just seeing how the economy turned out relative to how we were thinking it was going to turn out. I should say I'm really enjoying being involved in that review, and we are getting some, rich lessons from the last 5 years that will make us even better going forward. It's very beneficial. We're enjoying it. And I should also say that work is being peer reviewed by a couple of very eminent international macroeconomists, and we will obviously be publishing it towards the end of the year, and I'll probably make a speech on it as well, just to get it in the public domain.
But what can you learn right now from it, and how might that translate into the decisions, say, you made last week?
Like, we are a learning institution, so there's always some aspect of something being reviewed. How sensitive the construction sector is to interest rates or whatever. So we're always looking back to learn and improve how we're going. In terms of last week, we're also, we'll run policy simulations. If we change this, how does that affect the rates outlook? We're always doing things like this to give us, this is economics that we're doing. So it's an inexact science. So there's plenty of scope for learning as we go. And we absolutely do that on an ongoing basis. And, personally, I think it's great that we're also doing that, looking back over the previous 5 years.
And that takes into account 2020 and 2021?
Yeah, absolutely. It's from 2017 up until now, sort of mid-2022. So some pretty action-packed periods in New Zealand's monetary policy history and New Zealand's economic history.
Yeah, those 2 years in particular, 20 and 2021, national parties called for a specific review into the decisions you made in those 2 years. Do you think this 5-yearly review is sufficient enough to encompass that as well?
I don't really want to comment on what the politicians are up to or not. I am very. We're running this review in a very transparent and a very open way. We're coming at it very much with a growth mindset because that's how we learn. For me, as the chief economist of the Reserve Bank, I'm very confident that we will learn some really valuable lessons from this 5-yearly review.